In last week's video, we talked about a powerful options trade that can provide very high levels of profit quickly when things go as planned. But what do you do when things don't go as planned? Are you stuck hitting out of a losing trade, or is there a way to save it? I'm Seth Freudberg, the head trader of SMB Capital's options trading desk here in Manhattan. And the traders on our proprietary trading desk are trained to turn trades that are headed for losses into winners. And the good news is that this trade adjustment strategy is pretty easy to learn. If you'd like to learn how this simple adjustment works, then stick around, because I think you're going to find that this trick comes in very handy to turn a losing trade into a winner. Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for our options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so last week we took a look at an earnings trade on Apple that works out best when the stock doesn't have a particularly strong reaction to the release of its quarterly earnings report. And if that happens, you can almost always make a quick and very attractive profit. But life isn't always so neat and tidy, and sometimes the stock acts very violently, either bullishly or bearishly, to the stock's quarterly earnings release. And either one of those moves, if they're violent enough, can cause your trade to become a loser. But what most people don't realize is that option strategies are not binary. In other words, you don't have to just put the trade on and allow it to lose if the trade's going against you. You see, with option strategies, there's almost always a way to modify the trade, what professional options traders refer to as trade adjustments, which allows you to save a trade that is going against you, and in many cases brings it in for a win. Now, before we get into exactly how you can adjust an options trade through an example of an Apple earnings play from late last year, I wanted to let you know that if you would like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong in the direction, then click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in a new window, so don't worry, you won't lose this video, or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause this video, sign up now, and then resume watching. Okay, so now in order to teach you how this options adjustment strategy works through an example of a recent Apple earnings release, we need to do a really quick review of how options on stocks work so that everyone watching this video understands how they can be used to trade a stock's earnings. Now, if you already know how they work, just please hang in there. This is going to be quick. So what's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what price the stock is actually trading at any time before that option expires. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of a stock he owns at the strike price of that put, again, regardless of what price the stock is trading at any time before that option expires. The buyer of the option pays what's called a premium to the seller of the option, because the seller of the option is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. So in the case of a call, even if the stock's gone way above the strike price of the call buyer can exercise his right to buy 100 shares at that strike price. In other words, he's entitled to buy the shares way below market, which makes the call really valuable in that situation. Or conversely, as to the put, even if the market goes way below the strike price of the put option, the buyer of that put option has the right to sell his shares of that stock at the strike price of the put option that he's bought, even if the stock price has gone way below the strike price of the put, which again makes that put option very valuable in that case. On the other hand, if on expiration day the stock closes below the strike price of a call, unless it was previously exercised, the call expires worthless and the call seller just pockets that premium. Similarly, if you've sold a put and the market closes above the strike price of that put, then unless the put was previously exercised, it expires worthless and the put seller just pockets the premium. Okay, so back last October in 2021, on the day that Apple was set to release its annual earnings report, the stock moved up nicely over 150, probably in anticipation of a solid profit report after the market closed. And as we explained in last week's video, as a stock approaches its earnings report release date, particularly on the same day where after the market closes the earnings will be announced, options derived from that stock blowed up in value, and what options traders call an increase in options implied volatility. And so there are unique opportunities that emerge from that increase in options pricing, as you'll see in a minute. And so suppose that a few hours before earnings on Apple are announced at 12 noon on that day of October 28th, with Apple trading around 152.5, at that point, suppose that we pulled up the options chain expiring the next day, October 29th, and we went ahead and picked the closest calls and puts to Apple's price, which are the 152.5 options, and sold 10 of those on both the put and call side, and then went ahead and bought about 10 points farther away from the market in each case, the 162.5 calls and the 143 puts respectively. Well, that particular formation, the at-the-money calls and puts flanked by a long call and long put approximately equidistant from those short calls and short puts, that entire formation is known as an iron butterfly to options traders and is a commonly traded strategy right before earnings, like we mentioned in the video last week. So first of all, before we look at how this plays out, let's focus on the cash flow of this trade. And as you can see, when we sold the 152.5 calls, we received $220 for them. But remember, each options contract represents 100 shares of stock, so you multiply that by 100. And we sold 10 of them, so when you multiply it all together, you get that total positive cash flow of $2,200 just from the 152.5 calls. But then remember, we bought the protection of 10 of those 162.50 calls, so we pay $80 for those because they're far enough away from Apple's price. The market doesn't give them too much value. Then we move down to the puts, and we sell 10 of the 152.5 at the money puts, bringing in $21.20, and we turn around and pay $90 for the protective 143 puts, which aren't exactly 10 points because the 142.5 options weren't available, so we used the 143s, and those are close enough. And so once you net everything out, you receive a net total positive cash flow of $41.50. And your broker, by the way, will require $58.50 of capital in your account for this trade, which is also the worst case scenario outcome of the trade. Now, with an iron butterfly trade like this, there's a certain range, a kind of a profit zone around that strike price where we sold the 10 calls and the 10 puts, that 152.5 strike price. And that range, which is both up or down, is arrived at by dividing the amount of the net cash flow we received from selling that iron butterfly initially by $100. Now, in another video, we can delve into why exactly this is the profit zone, but for today's video, let's suffice it to say that given that we received $4,150 in positive cash flow, and we divide that by 100, like we said, that there's a range of $4.15 to the upside and the downside where we can make money on this trade. With the closer we are to the middle, that 152.5 price, the more money we'll make. And so the downside break-even point is 148.35, and the upside break-even point is 156.65, which is the range created by that $4.15 of profit zone to the upside and profit zone to the downside. Well, as it turns out, after hours, that same day, Apple came out with its earnings release. And so the next day around noon, it seems the market wasn't particularly thrilled with Apple's earnings. And so the stock began to sell off. And by noon, the stock had sold off to 148.51. Well, as we just said, the butterfly break even on the downside is 148.35. And so we're getting to the point where if the market goes much further, we're going to be in the loss zone. So are we stuck just having to lose on that trade if that's the way the market unfolds? And the answer is certainly not. What professional traders do at this juncture is to implement a trade adjustment known as a roll, where you take the short options on the side that is creating the problem, which is clearly the downside here, and you close those and reopen that same short options position farther down the options chain, in this case, the 148 strike. And the value of doing this, you'll see shortly. So by buying those 10 short puts at 152.5, we're closing that position out completely, because that's how you close a short options position. You buy it back. And so then after that, to complete the roll, you reestablish a new 10-lot short position down at 148. So that when the roll is complete, it looks like this, with the short puts now at 148 and no position at 152.5. That's been bought back. Okay, so at this point, let's reassess where we are from a cash flow standpoint, having made that roll. And as you can see, starting with the original amount we collected for the iron butterfly, that 41.50, we then reduced that by the cost of buying back those 10 152.5 puts for a total of $4,070. And then we add back what we got paid for those 148 puts, $240, for a total remaining positive cash flow of $320. Now, that's quite a reduction from the original cash flow, but still positive by a few $100. Okay, so now let's move to the end of the day on October 29th. And as you can see, Apple closed at 149.80, and that's the day these options expired. So at this point, these options can actually be finally valued. So let's take a look at how each of these options settled. And as you can see, starting with the net cash flow we kept after rolling those puts down, neither the 162.5 or 152.5 calls expired with any value, because the market closed at 149.80. So no one's going to exercise their right to buy Apple shares at well above where they're trading. So the call options just expire with no value. And similarly, no one is going to exercise the right to sell Apple shares at 148 or 143 when they can get more for them in the open market. So the puts expire worthless as well, resulting in the profit on the trade being that remaining $320 of positive cash flow, which we still retained after the roll. And so what I'd like you to take away from today's video is that, in contrast to last week's video where the market stayed inside the profit zone of the iron butterfly after Apple released its earnings for the first quarter of 2022, when the market's threatening to move outside of that zone, you aren't just a sitting duck waiting to lose a trade. You can defend the trade by rolling the options, and in many cases end up with a profit on the trade, even though the trade structure had altered, because you understand how to modify your trades to expand the chances of you profiting. Professional traders are trained to defend their trades, turning potential losers into winners, and now you've got some of that knowledge as well. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it, and please don't forget to hit our subscribe button right now so that you don't miss our free training videos to help you to up your game as a trader.